Good afternoon, and thank you for joining us today. My name is Yaron Orgil, and I'm a wealth advisor with Richardson GMP in Toronto. I'm pleased to have Errol Tenenbaum from Appleby and Jonah Pearson from Moscow & Company Chartered Professional Accountants to discuss the Finance Department's recent proposal to change the taxation for private businesses. All listeners are currently placed on mute during the prepared remarks. We will open the call up at the end for questions. You may also access the chat feature at the top of the screen at any time. First off, the legal stuff. As many of you can attest to, this presentation is for educational purposes only, and if you do have any specific questions for your specific situation, please contact your professional advisors to discuss. With that, I'd like to turn it over to Jonah, who will introduce the initial remarks and changes that the government is proposing.
Thanks, Yaron. So good afternoon, everyone. Just going to give a bit of background here. When the budget was tabled on March 22nd, 2017, the Department of Finance promised that it would release a consultation paper targeting tax planning strategies involving the use of private corporations. However, the Department of Finance only released a consultation paper on July 18, 2017, but draft legislation and explanatory notes as well, implying that it was serious about closing the so-called tax loopholes available to shareholders of private corporations. Finance is seeking input on its proposals by October 2nd, 2017, a very short 75-day window, considering this is the most significant tax reform in decades. The proposed changes in the paper can be found at the link in this slide. So the three strategies targeted by the Department of Finance are as follows. Income splitting, or income sprinkling as coined by the Department of Finance, holding passive investments inside a private corporation and converting income to capital gains. The lifetime capital gains exemption is part of the income splitting or income sprinkling strategy as well. So income splitting, or again income sprinkling, involves reducing income taxes by causing income that would otherwise be paid to an individual facing a high personal income tax rate to instead be paid to family members who are subject to lower personal tax rates. Under the current rules, dividends from private corporations can be paid to adult shareholders who may or may not be active in the business in order to use their graduated tax rates to reduce the overall tax burden of a household. Capital gains on the disposition of these private company shares can also be realized by multiple family members, including a family trust that can again allocate these gains to beneficiaries, which may or may not qualify for the lifetime capital gain exemption, essentially resulting in little to no tax on the sale of a company's shares, ignoring other complexities like minimum tax. So the Department of Finance is proposing to extend what is known as the kiddie tax, or tax on split income, to adults subject to a reasonableness test. These rules will be more restrictive for family members aged 18 to 24. So under the current rules, tax on split income generally applies to dividends on private company shares paid to minors and capital gains on non-arm's length dispositions. So essentially the dividend would be taxed at the top personal marginal rate, reduced only by the dividend tax credit and foreign tax credits. So there's already a provision of the Income Tax Act dealing with unreasonable salaries to family members that are not active in a family business. So this doesn't really deal with that. So under the proposed rules, the reasonableness test would take into account the payee's labor contribution, capital contributed, and risk assumed. So if the dividend paid was not considered reasonable, it would be taxed at the top personal rate, again reduced only by the dividend tax credit and foreign tax credits. So the tax on split income would not only apply to dividends paid on private company shares, but capital gains realized in the disposition of those shares, income on certain types of debt obligations, and reinvested income subject to tax on split income for adults under 25. So there are several possible unintended consequences that result in significant tax burdens being borne by family businesses and their estates built into this legislation that many tax practitioners have written about, as well as voiced their concerns in the media. But we won't get into some of these consequences. You can find several articles on LinkedIn and in the general media about it. These proposals would essentially shut down a strategy utilized by many small businesses and increase the burden of proving a reasonable rate of return to essentially all shareholders. This will, of course, give the CRA discretion and power to potentially attack any and all payments to shareholders. I'm going to pass it over to Errol.
Thanks, Jonah. Okay, so moving on to the lifetime capital gains exemption. As Jonah mentioned, currently the rules do allow for a splitting of this or multiplying of the capital gains exemption. Each individual who's resident in Canada, so each one of us over our lifetimes is entitled to take advantage of this exemption. And it's a frequent strategy currently to utilize it amongst more than one family member. So, for example, if you had a situation where there was a family trust and you had the business owner, his or her spouse, and their 2 children, you had the opportunity to potentially have 4 people using the capital gains exemption. Currently, it's approximately $835,000. It's indexed to inflation. So what that means is you're looking at over $3.2 million of capital gains, in my example of a family of 4, that would be entirely sheltered, tax-free. And that strategy is certainly one that is being attacked and is of concern to the federal government in these proposed changes. So what they have done is they've brought in, again, proposed that currently that the lifetime capital gains exemption would no longer be available to anyone under the age of 18, because currently it can be used by minors. Now they're not eligible. Not only are they not eligible, but any years that they own the shares where they were under the age of 18, the gain that accrued at that time would no longer be eligible. So if you have somebody who's 20 years old who held the shares since they were 16, at simplest, 1/2 of the gain that accrued in those 4 years wouldn't be available. They wouldn't be able to use the capital gains exemption. In addition to which, it's a common strategy for shares in a private company to be owned by family trust. And again, currently, taxpayers are able to utilize that trust to multiply the capital gains exemption, to split it amongst one or more beneficiaries of the trust. That will no longer be available. And again, whether it's held in the trust at the time that the shares in the company are sold, or if there's a subsequent distribution of those shares to individual beneficiaries, the gain that accrued while it was owned by the trust, while the shares were owned by the trust, will not be eligible for the capital gains exemption. Again, as Jonah touched on, if the income that's earned on those shares is considered split income, if it's income sprinkling, then again the shares would not be eligible for the capital gains exemption. As I'll touch on later in terms of tax rates, what you could be looking at again is, as opposed to a capital gain, it would be taxed as an ineligible dividend, and what that means isn't a technical term, but there's different classes of dividends, and the highest rate of tax on those dividends is a little over 45%. It should be noted that there are transitional rules that they proposed that would allow taxpayers in these scenarios to essentially what's known as crystallize their capital gains exemption. What that means is you would essentially trigger a disposition for tax purposes to allow you to take advantage of the current rules before the new rules are put in place. And it's 2018, but it's important to note, of course, that we're not entirely sure where they ultimately will land. And of course, as a result of that, you really should be diligent to make sure that any planning you want to implement happens sooner rather than later, and at the very least that you consult with your advisors, because it might be that certain steps already have to be taken in 2017. Before I pass it back to Jonah, just note, as I said before, I mean, this is very common planning and has been common planning to set up a family trust, to have family members as shareholders of a family business. This has been commonplace for 50-plus years in various incarnations. And for sure, regardless of where we end up, if these proposals move forward in one way or another, planning will be really turned on its head. And so, as I said, if you do have a structure like this, even if, whether it qualifies or not, it's certainly important to speak with your advisors on it.
Thanks, Errol. So the next strategy that the government is looking at is holding passive investments inside of private corporations. So essentially the way the system works is tax integration is essentially income earned by a corporation and distributed to shareholders as dividends should basically bear an amount of tax that is equivalent to what an individual earning the income directly would pay. So one of the many reasons that businesses incorporate is to take advantage of the tax deferral. So in Ontario, essentially paying tax on the first $500,000 of active business income at 15%, or at the general corporate tax rate of 26.5%, versus earning that income personally at the top personal marginal rate of 53.53% in Ontario. So finance is concerned that owners of private corporations have been accumulating excess earnings inside their corporations while paying tax at the low rates and then investing that capital in so-called passive investments like portfolio of securities, real estate, et cetera, rather than expanding their businesses. So, however, as many of you know, businesses don't always earn the same income year over year or even continue to grow at a guaranteed rate. Therefore, business owners do rely on this capital for leaner years, as well as hopefully to subsidize their retirement down the road, in addition, of course, to all other responsibilities taken on by a business owner. So finance is seeking to introduce very, very complex rules to eliminate the financial advantages of investing passively through a private corporation by essentially reforming the current system. What this means is that there will be an additional non-refundable tax incurred by businesses that used to essentially be refundable when dividends were paid out to the shareholder or shareholders. On a flow-through basis, in certain situations, this could result in essentially a 73% tax rate on investment income and 59% tax rate on capital gains, putting the owner of a private corporation on the same level playing field as an employee that invests his or her after-tax capital at the top rate in passive investments and earns investment income on those investments and then pays tax on that income, again, at the top personal marginal tax rate, again, depending on type of income. So this was the only strategy that was targeted for which no draft legislation or explanatory notes were written, as the so-called approaches proposed by finance are quite complex and actually would be quite complicated to apply in practice. Finance has stated there will be an election for certain companies focused on passive investments, where the corporation uses earnings that were taxed at the personal level to fund these passive investments to continue under the current refundable tax system. But again, we'll have to wait and see what comes out after October 2nd, but it appears that the government is not necessarily softening its stance on any of its proposals. Back to you, Errol.
Thanks. I would note, as Jonah mentioned, of course, a lot of this is in flux, and we're really not sure where it will end up, particularly when it comes to passive investments held inside a private corporation, given that there is no draft legislation. I would note that yesterday, there was a column in the Globe where Finance Minister Bill Morneau did mention that it's the government's intention that that these changes will only apply on a go-forward basis, and that existing savings will not be impacted by these rules. What that means in practice, we'll have to wait and see. Again, all of this is in flux, so we're not really sure where they'll land, and one hopes they'll dial it back considerably. But at the very least, I'm hopeful that even if they move forward, that the existing funds in private corporations will be segregated into a pool and treated under the current regime. But I say hopeful. It doesn't mean that will be the end result. In any moving on to the next type of transactions that the government is targeting, as you can see from the header, is converting income into capital gains. over the years, and certainly in more recent years, it's come to light that there's been a lot of aggressive planning whereby individuals are able to convert what would be dividend income into a capital gain, and this is commonly known as surplus stripping, the technique. What that means is, again, there's a surplus in the company, and there are techniques available to strip it out of the company, to take it out of the company at the lower capital gains rate. As you can see in the slide, dividends are taxed at the highest rates vary from around 39% to up to over 45%, whereas capital gains are taxed at slightly under 27%. And as a result, obviously, that's a significant spread. And so it's only logical or not surprising that taxpayers would want to pay at a lower rate. Understandably, finance was concerned with this loophole, and by and large, in certain respects, in certain circumstances, it is considered a loophole. So they've implemented rules which are very technical. I won't get into the particulars of the rules because, as I said, it's quite technical in nature. But the point is they're trying to close that loophole. They're trying to ensure that the only way that funds are taken out of a company, generally speaking, is by way of dividends, putting aside salary, etc. They do recognize, and one of the problems that exists is, of course, this could result in first a capital gain being triggered or tax on a capital gain being paid at 27% or capital gain within the corporation, and then subsequently those funds are then subject to the taxable dividend rates, which again could be as high as 45%. They do recognize that, and they are open to suggestions, but that is certainly a concern. Another concern is this strategy is also or often known as what's called a pipeline. It's a pipeline strategy that once you pay a capital gain and you've paid that 27% tax, that you should be entitled to take the after-tax funds out, let's call it tax-free, without any additional tax. Particularly, it should be noted that this occurs when someone passes away. This isn't tax planning, that's death, and when someone dies, there's what's known as a deemed disposition. What that means is they're treated as having sold all of their assets, and any assets that have gone up in value, such as shares of a private company, would be taxed as a capital gain. Again, the problem is there might be funds in that company. They might have paid the 27% tax, but that doesn't allow them to simply take it out tax-free. So while their concern, they being the government's concern, was people doing this during their lifetime, the result is they almost assuredly, at least the way the legislation is drafted right now, have done away with the ability of estates from taking out that money without incurring additional tax, especially if they don't take certain steps within the first year after the individual dies. Another concern is that this will also target transfers between generations, right? It's quite common that you have a business owner who has built up their business and wants to pass it on, whether to their children or if it's a corporation that's owned amongst siblings. It might be that one of the siblings is going to take over that company with the intention that their children ultimately take over. And while the government has said in the past and continues to state that it's not their intention that they are trying to do away with these intergenerational transfers, in practice, these rules, as currently drafted, and it's important to say that, almost assuredly would apply and could significantly increase the tax burden on the next generation and on the parents selling to the next generation, even in situations where it's 100% of sale, it's and government acknowledges, even under the assumption that the price that the children are paying for shares is the real price, that they're not getting any sort of discount. In any event, these rules will apply. Finance is saying that they're seeking feedback and they want to be able to better accommodate these transfers. But as it is right now, those transfers would be negatively impacted, and it is important to note that if ultimately enacted, these rules would all be effective as of July 18th when they were originally introduced. So there is no current, call it retroactive planning or planning ahead of 2018 that can be done for these particular rules.
Thanks, gentlemen. So just some of the next steps and what can you do. So obviously, Jonah touched on the 75-day consultation period. That is open until October 2nd, 2017. What can you do in the interim? We recommend, and a lot of people have been voicing their opinion, you can call, email, write to the Finance Department and or your Member of Parliament to express your views. We've listed the email for the Finance Department. There's also a link there to find your MP if you don't know who they are. And if you're not sure what to say, there's numerous letters that can be found on LinkedIn, on Facebook, other social media sites. If you still can't find them, reach out to us. We can point you in the right direction where you can find those letters, and that way you can customize them to your specific needs and your specific views. With that, we're going to open it up for any questions, and if you do have any questions, you can. I'm going to turn the mute off, or you can also type your question in the chat box at the top if you don't actually want to speak. So the mute is off, so if anyone has any questions, please go ahead. We'll give it a couple more seconds in case anyone's shy, but if not, we will end the call in a minute. If you do have any questions after the fact, though, again, feel free to reach out to us, and we'll be happy to discuss them at that time.
Saying you can do anything except call your MP. Basically, they're not saying, so this is what you should be doing with your money.
Well, the thing
They're
is,
not saying that.
they do not.
Okay, well, with that, again, thank you everyone for joining us, and again, if you need anything, please reach out to any of us. Thanks very much.
Thank you.
Thank you.
Empty or not?